Hello, my dear Web3 enthusiasts. This is Mike speaking, and welcome to the new exciting episode of Synopsis. Today I'm hosting this one with Jacob Phillips, co-founder of Lombard Finance. I'm gonna speak a lot about Bitcoin staking, of course, so it's gonna be interesting. Hello, Jacob. How are you today?
Yeah, I'm great. Thanks for having me.
Always a pleasure. And yeah, we have a lot of questions to discuss for today, so let's get straight to the action.
Yep.
To begin with, a little bit of introduction to warm up. So could you please introduce yourself and your personal journey in Web3?
Yep, definitely. Yeah, good to meet everyone. I'm Jacob Phillips, one of the co-founders of Lombard. My story was I was sort of doing traditional finance in school, very late in the game. Decided to start a CS major and start exploring technology a little bit. I knew nothing about technology, had zero exposure to it growing up, but was just kind of like doing a ton of independent research and ended up getting a gig at a small startup accelerator in Cleveland that was launching a blockchain fund sort of through this government funded movement. They forced me to sit down and look at the tech. This was like late 2018 at this point. So there was already so much momentum. It felt like crypto was past the point of no return. So my options were, get in at the ground floor of some, new technological movement or go into traditional finance and, work for someone for until, who knows what age. Yeah, just ended up being sort of the perfect bet. Took a little bit of a leap of faith, ended up like, moving away from that into like just going back into basically being an intern at these like crypto funds for whoever would respond to my emails for a little bit. That ultimately kind of like stepped my way up from a couple different funds to get a job at a school at Polychain. I was there for 3 years. I was an investor on the ventures team, did a little bit of liquid fund research there, spent a ton of time focused on DeFi. And then, of course, in the bull market, a little bit of everything else, NFTs, gaming, whatever else was fancy at the time. Yeah, left that to join a DeFi studio called Equilibria that focused on a product called Perennial, which was a on-chain DeFi perps protocol that was like a little bit ahead of its time in a lot of ways from a design perspective. Yeah, ended up leaving that to start Lombard in May 2024. Yeah, the rest is history. Been building Lombard for about a year. I've had a ton of success. I've sort of, almost exclusively focused on Bitcoin DeFi for the past year of my time, which has been great. I sort of went like really broad at Polychain, then to like really narrow building an on-chain perps protocol, now to like operating broadly across DeFi, but with an exclusive focus on Bitcoin, which has been great.
Wow, awesome. What a great intro. Thank you. And see so much energy in the way you speak. So today's discussion gonna be hot. Well, awesome. So now we know the story of how you actually came into Web3. Could you please also tell us how you came up with the idea of staking Bitcoin?
Yeah, yeah. So, we started off the idea of staking Bitcoin sort of through some, I guess having insight into where the space was headed and some personal relationships. So, at Polychain, we sort of had front row seats to the whole restaking movement, seed round investors in Eigenlayer, and then Polychain ended up leading the Babylon Series A, I think it was. And so, we kind of seen all this stuff coming. I had spent a lot of time, or not a lot of time, maybe like a month or two at Polychain going super deep into Bitcoin DeFi back in like 2020, 2021, back when not a lot of stuff was happening. We did an investment into what was the best Bitcoin DeFi project at the time that didn't fully come to fruition, but had always kind of been on the back of my mind. There was sort of this like very obvious opportunity in the background of we've built this whole on-chain financial ecosystem. The biggest asset by market cap, Bitcoin, is left out of all the fun. Surely Bitcoin should make its way into on-chain finance at some point. The question was just like, when is the catalyst going to come? And having pretty close relationship with the Babylon folks, leading up to the launch of their protocol, it became very clear that like the thing that was missing was this like exogenous incentive to get people really excited about Bitcoin and DeFi. WBTC sort of made like a little bit of headwind, I think, when it was sort of being proliferated throughout DeFi summer, but mostly used by institutions. DeFi protocols never really cared about it that much. The introduction of like a staking mechanism for Bitcoin, a native yield source for BTC that could then be used as like the catalyst for proliferating BTC on chain. That is bringing BTC out of the depths of cold storage into something a little bit more active. Like the step from like zero Bitcoin activity to now I'm staking it makes it such that the step from staking to DeFi is like much smaller. It's a big step to like bring out of cold storage. Staking to now depositing Bitcoin in Aave is like a very small step, really. So that really has been the catalyst. We like recognized that there was this huge opportunity with Bitcoin staking coming online to then get people excited to onboard Bitcoin into Ethereum, Solana, some of these existing ecosystems that had really well-developed DeFi ecosystems, and just sort of ran with it. So yeah, became a really close partner of Babylon. We launched not the first Bitcoin liquid staking token, but I think the first Bitcoin LST to scale quite big, to become adopted within DeFi protocols. I think that Lombard is Lombard's LBTC, this liquid representation of staked Bitcoin. It sort of led the way for all sort of yield bearing Bitcoins in terms of security standards. We were the first with a proof of reserves mechanism, the only one that wasn't purely based on centralized custodians. To start, I'm trying to think what else. I think we led the way on other security stuff. We were the only Bitcoin LST that hasn't depegged multiple times. We're the only Bitcoin LST on all of the major lending protocols. That is like anybody with a risk team kind of doing reviews before they onboard assets. Lombard is like basically the only asset that's sort of been included there. And we went $0 to $1 billion in 90 days. I think like just about the fastest anybody's ever done it in the industry. And all of this was due to the fact that like we kind of just found the killer product at the killer time. So all of the stars sort of aligned. People were looking for stuff to do with their Bitcoin. There were like all of the off-chain solutions, like off-chain Bitcoin yield solutions had dried up in the aftermath of the collapse of FTX and Genesis and BlockFi. So there's a beautiful opportunity for DeFi to step in and kind of regain the throne a little bit. Bitcoin staking was the catalyst. This then onboarded a lot of Bitcoin into DeFi. And now the name of the game for Lombard is actually less Bitcoin staking focused and more focused on distribution of Bitcoin liquidity within existing ecosystems. So this has kind of been the name of the game from day one. Now we have just really like found, I think in the aftermath of all of the things that have happened with Bitcoin LSTs, Bitcoin DeFi has sunk its teeth into the heart of on-chain finance. And now we're past the point of no return.
Oh, sounds great. And several times you mentioned Babylon, guys. Actually, about 2 weeks ago, we just had an episode with Fisher Yu from Babylon. Yeah, and I'm really excited to know more about BTC staking because although I call myself a Bitcoin maxi, shame on me, I never tried Bitcoin staking. And probably a major part of our audience have never done this. Depending on what we're going to discuss today, maybe we will encourage people to do this.
Totally. Yeah. Well, you should definitely check out Bitcoin staking. I will say Bitcoin staking has really only been a thing for about a year. Like the magic of Babylon was that they created this fully on-chain, non-custodial Bitcoin staking mechanism. Maybe one of the only highly successful fully on-chain like expressive mechanisms built on Bitcoin L1. So really cool technology. I mean, I'm sure Fisher gave a great explanation of
Sure.
Bitcoin staking and walked you through the whole ecosystem there. But yeah, I mean, it really was like a bit of a 0 to 1 innovation that has sort of changed the way the entire Bitcoin space thinks about this. I mean, Babylon and Lombard kind of as a team going hand in hand to make things happen in the Bitcoin space now has like totally restructured the idea. There's this like idea that everybody is sort of pushing this idea of like a Bitcoin renaissance. And I think I feel this quite clearly, both within the Bitcoin community, where now, much of in the aftermath of, billions of dollars flowing into Bitcoin staking mechanisms and LSTs being like the primary way for new chains and DeFi protocols to, onboard a ton of liquidity. Like, for example, Barachain launched, onboarded $600 or $700 million worth of LBTC. This is like the way you onboard Bitcoin into new ecosystems. Now I think it's opened everybody's eyes to like what Bitcoin as an asset could be. Before, there was a lot of like aversion to the idea that Bitcoin would become an asset in on-chain finance, and now it's an inevitability. And then we also see this like DeFi renaissance, or sorry, this like Bitcoin renaissance happening in existing ecosystems where like all of DeFi was built on ETH and stablecoins, and now the introduction of Bitcoin is like shaking things up. Same with like, you know, if you're Solana or a Bitcoin L2 or Sui or one of these other ecosystems, I mean, Bitcoin like really is the primary go-to market for like growing your TVL quite substantially, maybe outside of stablecoins. So yeah, I mean, the environment is shifting quite significantly, and it's yeah, I mean, we'll see where things go. It has been really cool to work with ecosystems who are like sort of building DeFi ecos from the ground up, where it's like if you start from first principles, of course you would build a DeFi ecosystem on Bitcoin. We sort of built Bitcoin without the technology to be able to or excuse me, we built DeFi without the technology to be able to like embed Bitcoin, the like hardest money, the, you know, one of the only products in crypto with true product market fit at the foundation. And now there's new ecosystems doing this. There are existing ecosystems putting a ton of effort into, you know, making Bitcoin a priority in sort of growth plans. So yeah, everybody's excited about BTC. I think that's what's very clear.
Yeah, absolutely. And I might say that holding BTC is a pleasure itself, and holding, staking BTC is another layer of pleasure. So definitely got to go and try this, and to convince people to move forward to making these first steps and making these actions more viable. So I think we should solve the questions about the security. So could you please go ahead and introduce actually security measures Lombard takes to prevent defaulting?
Yeah, definitely. Great question. So security is by far the number one thing that Bitcoin holders care about, especially big money institutions. You can get away, you know, with retail. There's always ways to, you know, have slightly less secure solutions that get the job done in the short term. But on a long enough time frame, or certainly at scale, security is the only thing that matters, much more than a high yielding product or like a really usable product. So like security has been the sort of reason that Lombard came to start this project, was because we were sort of looking out at the ecosystem and looking at existing solutions, basically realizing that like there was an opportunity, or more so a need, for an institutional security first blue chip sort of protocol to pop into the Bitcoin space, embed liquid staking, liquid Bitcoin staking at the core of what we do. And so, you know, we sort of built this full stack product for LBTC. LBTC being a liquid staked representation of Bitcoin. This has sort of been Lombard's core product. So users deposit Bitcoin into the Lombard protocol. The Bitcoin is staked into the Babylon protocol, starts earning yield, and then LBTC is minted as a liquid representation of the staked Bitcoin. So this was the product. We built this stack. So to kind of talk through the security here, if you want to build anything on Bitcoin, you need an expressive mechanism. Bitcoin doesn't have smart contracts, so if you want some sort of smart contract functionality, even something as simple as like mint a token if Bitcoin is received, like very, very simple business logic in the grand scheme of things, you need some sort of additional layer on top to be able to execute that logic. So to do that, we created a decentralized consortium of some of the biggest institutions in the space. The idea being, if your Bitcoin is going to be secured by anything other than Bitcoin L1, the only way you're going to scale this, scale security for Bitcoin up to like $10 billion in TVL or like $100 billion in TVL is going to be like, you can't trust the Lombard team. You can't trust like one centralized institution. You really need to be trusting like a consortium of the biggest parties in the space, So we onboarded, like OKX runs a node in the validator consortium, DCG, Wintermute, Galaxy. Like these are the kind of folks. These are the types of folks who are like, this is the entire crypto space. If these guys steal your Bitcoin, then we sort of don't know what to tell you at that point. So right now, the Lombard Consortium is a group of 15 of some of the biggest players in the space. This consortium originally operated in a private sort of permissioned consensus protocol, or I guess the consensus is still permissioned, but it ran on Raft consensus to start. This was just to kind of get it up and running. We then sort of transitioned it to a BFT protocol, so now it runs on Comet BFT. that very sort of standard consensus you'd see in a lot of Cosmos chains. The consensus is basically just to operate the Bitcoin bridge. That is the Lombard consortium. Each of these like big entities or institutions in the space run a node that does like a very restricted number of things. It notarizes deposits. It allows for the minting of LBTC. It basically operates the rules of the Lombard protocol. That is like one LBTC should always equal one BTC. Within this, like another layer of the stack, on top of the sort of like the foundation of trust is the Lombard consortium that operates via this consensus mechanism. On top of this, we have a key management solution that we use called Cubist, or Cube Signer is the name of the actual software product. Cubist, they were some of our earliest security advisors. They helped us build the initial implementation of the protocol. We have been walking hand in hand every step of the way with them. These folks are Carnegie Mellon professors. They built and sold a Web2 cybersecurity company. They are custody and key management experts. So, I mean, when we were starting this protocol from the beginning, we knew that we were going to need to be able to secure a lot of Bitcoin. Certainly, we have some expertise internally, but who better to go than like the absolute experts to help us build this protocol? So that was sort of the impetus there. The Cube Signer protocol is incredible because it sort of acts as a set of off-chain smart contracts for everything that the consortium will do. So the Lombard protocol is built in a layered security stack with the idea being, multiple of these layers at any time could fault theoretically, and the system would still be secure. So the sort of invariant that we're holding true at all times is one LBTC or one asset minted against an underlying Bitcoin should always be representative of one underlying Bitcoin. So, this was sort of the idea. The way we do that is we sort of use Cube Signer to sort of enforce this set of off-chain policies that act as smart contracts that define very simple things like if one BTC is supposed to be withdrawn, there needs to be a one LBTC burned that corresponds to that. So all of the rules of the protocol are sort of enforced by that. On top of this, there is a set of time locks for any sort of changes to the protocol, and there's sort of a delayed withdrawal mechanism that makes it such that all Bitcoin that is withdrawn from the protocol, like you can't end up with like a Bybit situation where $1 billion just gets withdrawn instantly. There's like a certain delay before this would be enacted anyway. In which case, there's sort of a security mechanism that will allow us to revert any sort of fault in that protocol. On top of this, there's one additional check that is pretty cool called Cubist Bascule, which is basically like an independent oracle that sits there to just verify the invariant. So before any sort of withdraw or mint of LBTC can occur, it goes through one last like entirely independent check from the system that basically says like, does one LBTC equal one BTC? So this is kind of cool. The good part is, none of the systems have faulted to date. We haven't had any DPEGs, security incidents, or blocks from Cubist Bascule, but all of these sort of guardrails are in place for when inevitably the system gets challenged in some respect. So I think we built it to be maybe more secure than we needed to from day one, but now Lombard has scaled up to a couple $1 billion in TVL, and these things are starting to become like very, very real, especially as we talk to institutions who are looking to deploy billions of dollars in assets. If you don't have these kind of security measures, I think it becomes a bit of a non-starter. So maybe there was a bit of a more in-depth security review we needed, but I think all of this is important because what's interesting is like each of these foundations of the Lombard protocol, that is the Lombard consensus mechanism, which we now call Lombard Ledger, and the Lombard consortium, which is like the root of security, and this like key management layer, which we built for Bitcoin. Now, all of these products that were built in a tightly integrated stack specifically for LBTC, which was our core product at the time, we're now realizing can live as standalone products. So Lombard Ledger is now has like a life of its own. The Bitcoin security solution on top can now be used not just for Bitcoin liquid staking, but it can be used for a Bitcoin wrapper or other sort of Bitcoin vault products. Like there's a lot of each of these layers of the stack have the potential to do a lot of things independently. So this is what we've been spending a lot of time exploring, I think, the past like 3 months, and really where Lombard's headed.
Well, the security and the information of security is never too much. And there should be no more questions left, I think. But still, if any one of our viewers still have some questions left, so guys, the comment section is open. just drop your question, and I do hope we will see Jacob in more episodes and we'll discuss your questions. And yeah, what you've just said, several questions arising. And firstly, I wanted to ask about institutional adoption, but let's put it for a bit later. And in between, you mentioned also that you're one of the biggest players in the space. Could you please tell us how Lombard grows so big so fast? What is the success story?
Yeah, great question. Timing is everything in crypto, and Lombard just launched the right product at the right
Hmm.
time. Bitcoin was looking for yield on or off chain. DeFi, this Bitcoin staking mechanism within on-chain finance in Babylon was going to offer that yield. This was then the catalyst for onboarding Bitcoin into DeFi applications and new chain launches, all of which were begging for new liquidity. Like every chain in DeFi protocol, I mean, maybe I should have broke it down like this. Every Bitcoin was looking to be put to work, not every Bitcoin, but like billions in Bitcoin were looking to be put to work and earn a yield. That was kind of step one. Step two is like every chain in DeFi protocol was looking for new liquidity. So being able to match the two of those, you had a perfect market mechanism that was, incentives for onboarding Bitcoin, just an absence of technology to do this. So, I think we just kind of ended up launching the perfect product at the perfect time. I think that's kind of the gist of it. And then, what I think this has done, I think I alluded to this earlier, but the fact that you had this sort of early mechanism, like I said, I think we went, $0 to $1 billion in like 92 days. This could only happen if this product was like finding product market fit right out the gate. And now I think knowing that Bitcoin has product market fit, in on-chain finance, specifically within existing ecosystems. Now I think this opens the door to so many more possibilities because now we're thinking like, okay, with beforehand, with the initial launch of LBTC, we were just sort of trying to prove out that like people actually want to use their Bitcoin on chain or in DeFi. Now that we've done that, and it's very clear that Bitcoin is going to become a core asset within DeFi, our mind shifts from like onboarding $1 billion in TVL now to like how are we going to onboard $100 billion in TVL? So it shifts. I think it shifts the like mindset that we've operated with quite significantly.
Awesome. And yeah, what I might add here is that some might think that dropping the right product in the right timing is kind of luck, but I would say that feeling this right moment and catching it, being ready for it, is a great skill itself, an achievement, and it doesn't come from nowhere, from nothing.
Totally. Yeah. Well, I appreciate that certainly, and yeah, I would say if anybody's looking to build a crypto product or think about building a startup in any sense, you really have to build with a sense of urgency. And to be honest, I don't think I did this in my investments at Polychain, and maybe even in the first sort of project that I was uh, building at a startup. But certainly, this was the MO for Lombard, and really is the reason we've had so much success. We launched a product with an edge that users were demanding, like knocking down our door to get, and there's no better feeling than that.
Absolutely. And yeah, as I promised, so a big question about the institutional adoption. So we already passed questions about security and everything seems clear there, but what about the risks? So for example, 5 years ago, companies could only invest like 1-2% of their assets in Bitcoin because it was considered a high risk asset. So well, the question is, what are the current institutional adoption strategies for Bitcoin, and what efforts does Lombard take to make a difference here?
Yeah, so maybe I'll back this up to the beginning of Lombard as a project. I said that we started this off to be this like blue chip, institutional friendly type of primitive. At that time, this is like beginning of 2024. We sort of knew that institutions would come along at some point, and there was some narrative around institutional adoption. But man, we couldn't have drafted a better story. I mean, the stars just totally aligned the second we started this. So in tandem with Bitcoin sort of starting to find product market fit in on-chain finance, what was it like? That summer 2024, you had Bitcoin Nashville where Trump is coming to speak, and then November, new administration gets elected that's pro crypto, and then I can't remember this was maybe this was like a couple months ago or something like that. You have the chairman of the SEC, I think maybe the CFTC, basically saying like on-chain finance is here to stay and America's going to be supportive of it. Like the way that the regulatory landscape has shifted, or like the level of institutional and more importantly like sovereign adoption of Bitcoin has just absolutely blown our mind. Like we couldn't have planned this better. So the amount of tailwinds behind institutional adoption, just in general for the whole crypto space, has just been absolutely incredible over the past 12 months. And it just so happens that there is one asset, maybe two assets that institutions actually care about. Bitcoin being by far, I think, the most adopted at this point. Stablecoins being a massive catalyst for institutions as well. Everything else, I think, is like an order of magnitude below those two assets. So when you're talking to institutions about crypto, Bitcoin is the perfect sort of onboarding mechanism with which to do this. And the other thing that I think sort of worked quite well with timing was like institutions were staking ETH, or they were familiar with the concept of staking. They've kind of gone through the diligence process before, so like doing things they had already done with just an asset that they appreciate more or could do at much larger scale, I think is kind of a no-brainer. So this has been Bitcoin Bitcoin and on-chain finance, or like Bitcoin DeFi products in some sense, has been something that I think institutions have been looking to pitch for quite some time. They sort of just been waiting for the industry to grow to scale. So Bitcoin staking has kind of been a no-brainer. I made this comment before, and I still think it to be true. I think that like Bitcoin staking was adopted by major institutions within the crypto space, like a fully non-custodial mechanism, faster than any other product that I can remember happening. Like, custodians adopted it really quickly. You saw like major financial institutions like starting to run nodes on testnets and start serving Bitcoin staking to clients. Like this was the perfect onboarding mechanism, I think, for Bitcoin, and now has opened at the door to all kinds of things. I think every major financial institution is thinking about what products they should be serving to their clients, and Bitcoin is always at the heart of this. So Bitcoin yield is usually where things start, because it's like if you have a lot of Bitcoin assets within custody, you want to like put them to work as an institution to start to earn a larger cut. Or if you don't have assets custodied within your protocol, you kind of like, or rather within your custodian or some financial institution, you need to like come up with some reason for people to like deposit their assets within that group. And yield is sort of the persuasion with which to do that. There is yield started with staking. This is a beautiful mechanism, very DeFi native type of risk. But I think where a lot of the Bitcoin yield space is going right now is actually focused on bringing off-chain yield on-chain. So if you look at where Bitcoin is used right now, like if you think about yield in general, yield comes from utility. People use Bitcoin. There's now an opportunity to like do some arbitrage or do some sort of trade because of some market inefficiency. If there's if there is no actual activity for Bitcoin, then there would be no yield to get. But because there's so much activity, now there's an opportunity to like, put Bitcoin to work. But you don't quite see a ton of Bitcoin. Like you see a very modest amount of Bitcoin activity on chain right now in the form of like true, utility. But Bitcoin is a massively used asset, like the most used crypto asset perhaps, but all of this is used off chain. So like people trade Bitcoin on centralized exchanges. They put it to work in borrow lend protocols that are predominantly off chain. They use it as collateral to trade perps and to borrow other assets and stuff like this. All of this happens in other venues. And so we really think is like, and to clarify, I mean, the scale of Bitcoin DeFi right now is like on the order of like low digit billions, right? And then the scale off chain is like, much larger than that. It's like an order of magnitude larger. So this is where you can get like really scalable yield. I think when we were first starting Lombard, I mean, we were just thinking about getting yield for any amount of Bitcoin. Like we would have been happy with $100 million. The fact that we got to 2 billion was like, incredible. Now that we're thinking about like, okay, how do we take this to $10 billion or $100 billion? The only place you can really do that right now at scale on a sustainable basis, like an institution, like an institution is looking for like sustainable Bitcoin yield above 1 or 2% for like something that they can deploy to for a year or 2 years or 3 years or something like that. The only place you can really find that is by leveraging places where Bitcoin is used off chain. So basis trade strategies, I think, are have come out as like one of the most scalable form of yield sources. Athena, nobody really thinks of it as a Bitcoin DeFi product, but it's almost entirely built on Bitcoin perps. So I mean that's such a killer product. Option strategies are very familiar for institutions and high net worth individuals. So I mean I think this is kind of a no brainer. We're talking with some of the biggest options market makers in the space who are making these sort of strategies a priority for them. And then I think there's all kinds of other things that'll sort of pop up kind of adjacent to that. There's a lot of strategies that involve collateralizing your Bitcoin, keeping full exposure to the underlying BTC, borrowing stables or borrowing some other asset against it, and then putting that to work in a delta neutral manner. That is a sort of killer primitive for us to do as well. And I mean, that, assuming you can get cheap borrow, that strategy applies to literally any other strategy that you could come up with. So it's basically like, just earning yield on top of your Bitcoin. I mean, that this is sort of a no brainer. So I think we're in full exploration for like all kinds of things here. Again, I think this is just a little bit of like, what kind of strategies will get Bitcoin to move faster than others. Because I mean that again, even though I've sort of said that a lot of our focus is shifted to building out the infrastructure stack a bit, these like different layers of the protocol that we built. Onboarding Bitcoin still is the name of the game. The faster you can mobilize Bitcoin, the faster we can, bootstrap these other layers of the stack in really big ways.
Wow, awesome. And another big thing everyone is speaking about right now, I would say, firstly, people were extremely excited about Bitcoin national reserves. Now, some might say that there is a threat hidden in that for the decentralization. So what's your opinion? Do you think it's a good thing for Bitcoin decentralization? Why not?
Yeah, this is in regard to like sovereign adoption of Bitcoin, basically.
Yeah.
Yeah. I mean, I think this. I think I alluded to this a bit in the institutional answer, but I think it's an amazing thing. Like Bitcoin has already gone through this, 15, 16, almost 17-year cycle of decentralization. The fact that we're now starting to see some of the biggest players in the space bop in, I think is perfect. I mean, the name of the game is uh, uh, for broad adoption globally. This has always kind of been the idea is like Bitcoin as this global non-sovereign currency. And the fact that we're starting to see not only like some sovereigns or some institutions getting involved, but the biggest in the space, I think is incredible. There was always this idea for quite some time. It's actually like institutions have been involved in crypto for a very, very long time. The fact that you're starting to see some of the biggest players in the space, the biggest players being like the US government, get involved in Bitcoin is a massive benefit to the whole thing for a couple of reasons. One, it legitimizes everything that we've been building for the past 15 16 years. It offers a bit of a challenge to the existing like sources of power that we've had within the crypto ecosystem. If you recall, like at any given point in time, there's always been like a couple parties who have been able to exert influence over the Bitcoin system. At one point, it was BitMEX, and at one point, it was like Binance when there was the Binance hack, and they were Binance was like, oh, should we roll back the chain? And of course, they didn't decide to do so. And there's been mining pools who at one point or another have had like significant portions of hash power to the point where people were like, oh, do mining pools control Bitcoin? And so I just think the more and more institutions we get involved in this, it stress tests the system, and more importantly, proves that there is no one party able to take down Bitcoin. Frankly, because now you start to see these, some of the biggest institutions in the space like start to build, material parts of their business upon this, and now you see even governments thinking of this as like a national security concern. They need to be involved in Bitcoin because it's like vital to the long-term success of the economy. All of this is just to say that the like out of protocol motivations for people to continue to operate Bitcoin consensus properly have grown exponentially, I think, just in the past couple of years, which means that, like, in my mind, Bitcoin security as a whole has grown quite significantly. So I think this is just massive all around.
Awesome. So recently, I had a common question addressed to Kyle Chessy at our podcast, and he had a common vision, and he also doesn't see threat for decentralization. And it's great to see you excited about more and more institutions getting on board. So I believe now 100% of our viewers, of those who had a little bit of scare about this, now feeling relief. So yeah, this is an interesting idea that it's a stress test. Let's think about it in this way. Also, we cannot but speak at least a little bit about regulation. So the question is, what do you consider the best and the worst crypto-related regulations that recently came into effect?
Yeah, that's a good question. I don't know that I have a best and worst answer here, but I will say just broadly, the regulatory landscape has been become exponentially more friendly to crypto, particularly in the US. I mean, I used to, see all these projects and builders very scared to say they're the US. Now, for the first time ever, you see people like proud to admit that they're a US company. And I mean, when we talk to lawyers and when we think about regulation, the US always seems to lead the way. So I think the biggest change is that like the fact that the US is now taking such substantial steps in favor of supporting crypto means that other jurisdictions will follow almost certainly. So I think this is massive. I think the biggest thing is like there's just starting to be clarity on this. The Stablecoin Act coming out, making it very clear like what stablecoins are going to be supported by regulation and which ones are not at the moment. I think just removes so much ambiguity that existed in previous administrations. I mean, there's nothing worse than building technology that you think is helping to advance freedom and human rights, and then being litigated against because a really unclear rule set you apparently violated. So I think it's just what this really does is it opens the door for builders to do what they do best without having to worry about going to jail or bad things happening. So I think it's great all along. I think this is what people have been asking for years. It's not that everything that we do in crypto should be absolutely legal for everyone. Obviously, I think there's a big camp of like pure I think there's kind of levels for things, right? Like some parts of the protocol should be purely permissionless, available to everyone. But at the end of the day, like there are reasons that we have rules and regulations, and it's to help protect investors from scams and stuff like this. So I mean, I think there are plenty of sensible regulations that we continue to the crypto space will continue to invite favorably. I think at the end of the day, we just needed somebody from within some of the biggest governments and institutions to stand up and be like, hey, maybe we should rewrite the rules a little bit for this new asset class, or maybe we should give a little bit more clarity to crypto. So I think, I think all of this has been huge. Thankfully, Bitcoin has been, much clearer from a regulatory perspective than I think other assets, but certainly all of the rules that are coming forth around stablecoins and on-chain finance are, creating ripple effects for everything that we do. Almost a bit of a catalyst for everything that we've been doing, rather than, something that's like unblocking us.
Awesome, thank you. And we're getting closer to the final part of today's discussion. So a few more questions left, and I think it will be a good timing to ask about the Web3 industry trends you are following most closely, because it's always interesting to know what our guests are tracking. And since you're the person who knows how to catch the right moment, it's extremely interesting to know what you are keeping an eye on right now.
Yeah, definitely. So I spend almost all my time in DeFi, so I'm not sure how basic of an answer this is, but the coolest. I mean, I think I've been excited about this for quite some time, both when I was at Polychain and now. The idea of capital shifting from the hands of like unsophisticated, kind of idle, like retail type user bases, people who aren't using their capital very effectively. That is like deploying really efficient liquidity into Uniswap or something like that. That capital now shifting into very like active, sophisticated DeFi vaults that are operated off chain by sophisticated actors, I think is one of the most amazing shifts. You basically see, in the same way Bitcoin is shifting from idle capital to productive capital, you see all capital in DeFi shifting from not that inefficient capital now to like highly, highly efficient capital. So for a long time, there's been this debate between AMMs and order books in DeFi. Order books, of course, being a massively more efficient mechanism, but harder to bootstrap, and AMMs being this like great way to put capital to work. Automated market maker mechanisms were like the first sort of step into taking otherwise idle capital and putting it to use productively. But AMMs were always pretty dumb. You know, they weren't that intelligent. They were doing something very simple. This is the same way that people were deploying liquidity in DeFi. You know, when I worked at Perennial, for example, we had like an extremely capital efficient mechanism to the point where you could deploy $1 of actual liquidity into the protocol, but produce 20 or $30 in liquidity for traders. So this is like, 20, 25x leverage if you want. But we saw that like, the people who were like retail was deploying liquidity into the protocol at like less than 1x leverage. So if I had a way to take all of that liquidity and put it in the hands of a really sophisticated actor, Lombard or Perennial could have like 20x its liquidity overnight. That's amazing. So when we started Lombard, this was the basis for everything we were doing. Was like we want to direct liquidity into the most efficient vaults and protocols. So you've seen like Veda and Concrete and Upshift and some others pop up to sort of help service this demand. You've seen like, and I think there's just so many cool things that are happening from here. This is like the same trend that GMX did for GLP. Then you saw HLP kind of expand upon this. The guys over at Paradex have a really cool vaults mechanism that allows for like cross margining across perps, options, and spot. These are the kind of things that are just, I think, are going to become more and more sophisticated. So it's sort of cool. Like if you're a really large institution, you might be able to like loan liquidity to a market maker, and you like go through all this KYC process and docs and whatever. It's like it's a huge hassle to do so, and maybe they'll market make for you, earn some yield. Now we're basically building these vaults so that anybody with some sort of sophisticated strategy can start taking in liquidity and putting capital to work. And you can the fact that it's fully on chain means that you can heavily restrict exactly what these actors can do. So they can't steal money. They can only deposit to some protocols. They can only, market make within a certain range. It's like really, really, I think very sophisticated and secure vaults are going to come out of DeFi in the near future, if they're not already here already. And I think that's just, amazing. The like access to really sophisticated strategies being democratized rapidly.
Yeah, sounds really amazing. Thanks for sharing a lot of things to think about. And we came up to the final thing I'd like to ask. Time for some piece of advice for our audience, some call to action, whatever you find valuable to share right now. So please go ahead.
Yeah. I don't think I have too much else to share. Definitely keep following Lombard, I suppose. You can find us at lombard.finance or Lombard_finance on Twitter. We just released our sort of new vision post that talks about Lombard kind of expanding from the single product LBTC now into a full stack infrastructure, building out Bitcoin capital markets, with the idea being we've proven out fundamental demand for Bitcoin. Now we're fully focused on like expanding on-chain utility. So this is like exponentially growing liquidity. And then the outcome of this, once you've created really liquid capital markets on chain, the outcome is that now you have created the catalyst for people to be able to actually build real Bitcoin businesses on chain. So the Bitcoin economy is in my mind past the point of no return. It's going to be happening. We just need to sort of like build up these steps one by one. So anyway, you should check out the full post because I think it's a great one. And otherwise just excited to continue to follow along with your community, with the rest of the Bitcoin community and the rest of the community excited about on-chain finance.
Well, a great ending, pretty logical and reasonable. And for today, that's it. So much information, but everything is in order. I feel like I just hosted a podcast with a Web3 Eminem. Sorry. And really enjoyed it. Thank you very much, Jacob, for joining.
Definitely. Thanks a ton for having me. Appreciate it.
Yeah, and a little bit of me addressing to our audience. Also, thank you guys, first of all, for watching until the end. I believe it's everyone who started because it was really hard and insightful. Once again, if you have any questions left, please drop it in the comment section. Follow Jacob, follow Lombard Finance on socials, follow Synopsis, of course, to stay tuned. And yeah, guys, thumbs up if you enjoyed it to see Jacob in more episodes. And have a great day, night, whatever is in your region right now. Bye bye, everyone.
Thanks, everyone.